The appeal of buy now, pay later is the built-in light at the end of the tunnel. People like the installments. They like knowing exactly how much I owe for exactly how long. Maybe that's 4 interest-free payments over 6 weeks. Many of these plans now are lasting longer, maybe 3 months, 6 months, a year, even a few years in some cases. Buy now, pay later is still small relative to credit cards. The market size is anywhere between 1 and about 3%. Credit card brands have taken notice, though. American Express, Citi, and Chase all have their own versions of buy now, pay later that they've built into their traditional credit card business.
Yes, Ted, at the same time, big retailers are getting on the same bandwagon, right? Macy's, Best Buy use Citibank to issue their own credit cards. Do you think there are plans for these big corporate sellers to rethink their lending models?
This has been a big shift in recent years. The store credit card space has been shrinking. Store cards and buy now, pay later really go toe to toe in the point of sale financing space. Store cards are pushed very aggressively at the checkout counter. You have a lot of cashiers saying, hey, do you want to save 20% off today's purchase? Here's our credit card. Buy now, pay later started as more of an online thing. It has moved into physical retail. I tend to think of these as being somewhat distinct, though, in that buy now, pay later is often the impulsive online point of sale financing, whereas store cards are still more commonplace in person. It's a good point, though, because a company like Macy's makes about half of its total profit from credit cards, according to Citi, which is really just astronomical. You could say something similar about a lot of other retailers and airlines. Buy now, pay later in some ways is a threat to that, but on the other hand, it incentivizes more purchases. The store is not taking on any credit risk. There are some ways that retailers benefit from this too.
I see. And which advantages do traditional credit card lines like Visa, MasterCard, and so on have that still doesn't exist with Affirm or Klarna?
Credit cards are very widely used. More than 80% of Americans have them. Credit cards have better rewards, they have better buyer protections. Credit cards have one big drawback, which is the high interest rates. The average credit card charges about 20%. And that's been an opening for buy now, pay later to come in and say, here's a kinder, gentler financing method. The lines are blurring. Many buy now, pay later plans are lasting longer, up to a few years. Many of those are charging interest rates similar to a credit card, maybe 15 or 20%. It's not always 4 interest-free payments over 6 weeks anymore. Another example of the blurred lines is buy now, pay later pushing into physical retail. Companies like Klarna, Afterpay, and Affirm all have physical debit cards now that you can use in person as well as online. I think the way this is all going is more of a cohesive kind of super app strategy. Kind of be all things to all people. Take Klarna, for example, or PayPal. They have different ways that you can pay right away, or you can pay in weeks, or you can pay in months. There's an element of consumer choice to that.
I see. And I'd like to dig deeper on the revenue model for these companies, right? The buy now, pay later model, because some of their loans are interest free. And it's sometimes hard to understand how they make their money, and especially in comparison with other financial products that are super profitable in the same space.
Merchants pay fees. So for credit cards, the average interchange fee is a little over 2%, about 2.2%, according to the Nielsen report. For buy now, pay later, it can be as high as 5 or 6%. That merchant paid fee can be significant. The irony is that merchants complain about credit card fees, and yet they seem much more okay with the buy now, pay later fees. Buy now, pay later has told a good story about, hey, retailers, you're going to sell more. You don't have to take on any of the credit risk. It's a very turnkey kind of thing. Retailers are often willing to pay for that business, with the data showing that they make more revenue as a result. Buy now, pay later sometimes has consumer paid fees as well. Sometimes there are late fees, sometimes there's interest, especially the plans longer than 6 weeks. Even the interest-free ones, though, someone's paying the buy now, pay later company. In that case, it would be the merchant.
And Ted, where do you see, which sectors do you see or types of businesses using buy now, pay later are the most promising, or you expect them to see the greatest growth?
Traditionally, it's been clothing, it's been electronics, physical goods like that. We've seen a big shift, though, the past couple of years into services as well. Everything from travel to dining, food delivery, medical, including dental and veterinary. Services seems to be a lot of the future push for buy now, pay later. It is riskier, it's higher ticket items, it's unsecured debt. Interestingly, though, even though the delinquency rate may have risen on buy now, pay later, it's still lower than credit cards. These companies do tout their proprietary underwriting. A lot of users like it and they want to keep it coming back to it, and they try to stay in good graces by paying on time. It's often a relatively short-term loan. Some say it hasn't been recession tested and it's risky. Others say the technology is in a place where they're actually doing better underwriting than people realize.